Hello, everybody. Did you ever wonder what it takes to build a company and get it to the point where you can go public? List on the New York Stock Exchange or the Nasdaq, one of the major exchanges around the world. There's a lot that goes into it. And my guest today is Marc Ross. He is a founding partner of Sichenzia, Ross, Ference, and Carmel. For those in the know, SRFC. Got it? SRFC. Sichenzia, Ross, Ference, and Carmel. And he is going to tell us a lot about what it takes. And he really knows, because you know what? This firm that he has founded with a couple of other really cool partners is consistently on the top of the charts for representation of the issuers, which are those companies that go public. So he knows a bit about what it takes to reach that pinnacle, get there, how you get there, and how you stay there. Thank you, Marc.
Thank you very much for the kind introduction. I appreciate that.
You know, seriously, you guys are amazing. You consistently stay on the top of all these charts as an issuer counsel.
What's cool is we started in 1998. It was three of us and a summer associate.
Really?
And today we have almost 70 lawyers, and we've done it by steady growth and helping clients understand their issues and helping them achieve their goals.
That is really something, because 1998 is the year I started my company, Investor Relations Group. I had no idea we were parallel starters.
Yeah, and so we've always done securities, corporate securities, finance, and litigation. That's always been the backbone of the firm. And as you mentioned, we're number one in the country representing issuers in pipes, and number three, tied for number three, representing placement agents. And there are firms out there that are much bigger than us, thousands of lawyers, but we have as big a securities practice as they do, and we're as active and knowledgeable as they are.
Can we talk about starting with just some of who are the players? You used the word issuers, then you said placement agents. What's an issuer for somebody who's watching this the first time?
An issuer is a company that's going public, okay? An issuer, they're issuing stock. So they are going to go out there, they're going to take themselves public, or they're going to have a bank take them public, which I'm sure we'll get into in a little bit. They are going to be issuing shares of their company. So that's the company itself. Now, if the company needs to raise money, they're going to go to a bank. What kind of a bank? Certainly not a savings bank, but an investment bank. So an investment bank will give them the opportunity to go public through an IPO, an initial public offering. And so that'll an investment bank. And a placement agent is the entity that raises capital. So if the company is public or wants to get public, if the company is public and wants to raise capital, it can hire a placement agent who can then place that investment with another party and get the $1 million, $2 million, $10 million into the issuer's pockets so it can develop.
Would you use the word investment bank and placement agent interchangeably?
Sometimes yes, sometimes no. But typically, for example, an investment bank typically yes. And in the investment bank is usually when you'll go through the IPO and they'll raise the capital for you. And the IPO is the traditional way that everyone knows to go public is through an initial public offering. Everyone knows that. We hear about that. We can look at the statistics on that. And, that's kind of a barometer for the marketplace these days, too, is whether the IPO market is opening or closing.
Now, what does it take for a company to get ready to even start to think about going public? It's in a lot of imaginations of a lot of entrepreneurs out there, but what are the realities?
Yeah, the reality is it really takes a lot. And I mean, first of all, it takes, the first thing that I always say it takes is it takes purpose. It takes directive. It takes, you need to really have a business model. You need to understand what you're doing. You need to have, the second thing that you need to have is you need to have leadership. You need to have somebody who can really tell the story, who can take the company to the next level. You kind of look at it like you're taking it from a private company where, we used to sit around the table and talk about it, but now we're bringing it to the marketplace and we're going to be examined by people. We're going to be presenting to people, telling them the story of what we're doing. Those are two things that you do. Another thing you need to have is discipline. And that's a really big thing. For example, as private companies, you don't take as much care to your financial statements. I mean, of course, you are careful of them, but you're not having them examined by a third party, a governmental agency. And when you're public, you need to have that. So you need to have your house in order. You need to have your books, your records. Everything needs to be properly documented.
Is that probably one of the hardest parts for most companies
I
to
think
go
it is.
from, when you run your own business, you can't, not that you have multiple sets of books, but you just decide where you want the money to go at any given point.
Right.
And all of a sudden you have these regulatory bodies, because those are quarterly filings for companies, or annual if it's a foreign entity.
Right.
That's a big hurdle for a lot of companies.
Well, and it's the messaging too. So I mean, the other thing is certainly you have to have, but on the other hand, that's an advantage. I mean, I always say we'll get into the pros and cons about being public, and everyone says one of the disadvantages of being public is you have all of this accountability. But I think there's a positive on that too, because when you have oversight, regulation, when you have outsiders looking at your books and records, there's more of a feeling and an acceptance and a realization that you're doing it properly.
And there is a lot of plus to that, because I remember when a vice admiral joined my company, all of a sudden, I really leveled up.
Exactly.
Because there's a big difference between an entrepreneur and a CEO.
Right.
Especially a CEO of a publicly traded company.
Absolutely. So the entrepreneur is the one who comes up with that great concept, really imagines it. And then the question is, can he implement it in the public arena? Another very important part, and back to your history, a very important part of being a public company and getting ready to be public is your messaging. I mean, no one knows the messaging better than you, because that's what you used to do. But the messaging, can you tell your story cogently, succinctly, and interestingly to the public?
Right.
Because you want people to follow your stock. You want people to believe it. Think about it. Why do you think there are all these commercials on TV? They want people to, understand the brand, get recognition for the brand, buy the brand, and increase their sales.
Right.
And I think that's something that also is very difficult as you transition to a public company, or get ready to your question, get ready to transition to a public company.
What are some other things companies should really start to, let's say somebody wants to go public. At what point in time should they start to be thinking about, here's a checklist of things I need to really start to prepare?
It's a great question. And I think the answer is sooner rather than later. The problem is too many people wait till later, and they didn't get the messaging out there. They didn't get the proper leadership. To your point about the entrepreneur versus the CEO, the entrepreneur is still making the day-to-day decisions when he should kind of remove himself and kind of sit up there and, see if his vision is implemented, but not be the one implementing it.
That's an interesting thing in corporate structure when you start to break down, what's the chairman's role? What's the CEO's role? The president, the chief operating officer, because they're all very different. And once you go into that, and the CFO, really different, when you start to go into that public company arena, those roles really become crucial.
Right. And the question is, do you have the best person in the role? Because, a lot of the entrepreneurs are brilliant and they come up with these great concepts, but they should never run a public company. And they should reap the rewards for their ingenuity and their innovativeness, but they probably are better off having someone else run the day-to-day operations of a public company, someone else appearing in front of the camera talking about the story that the company is implementing.
What do you think timeline, since you said they should start as early as possible, what are some of the first things, if somebody came to you and said, Mark, I have this great company, we're doing X number a year, because there's companies that make no money that want to go public. They're, let's say, the tech companies, the biotechs. They have an idea they're developing and they're just bleeding cash, but they can keep raising it. Or they're out of their friends and family round. Let's take it from there. Let's go back to that, because at one of these points, somebody says, I need a Mark.
Right.
I need somebody who can represent me as an issuer at some point.
I mean, I would say if you have a concept and you've already raised some of your friends and family money, and just so everyone understands, friends and family money literally is what it sounds like you go to your friends and your family and you say, I have this idea, I'm starting it out, give me some money. And they say, okay, this looks like a great idea, here's some money. Once you have that and you think you have a plan that could have traction, this is when, look, this is what we do. One of the things that's unique about Sichenzia, Ross, Ference, Carmel is, we have a model where most of the work that we do is on a flat fee basis. So what we do is we say, you come in, we won't charge you hourly. We'll figure out a program that would work with you. And we do that because, what's that joke where if a lawyer is inefficient, the issuer goes out of business. In my model, if I'm doing a flat fee, if I'm inefficient, I'm going out of business, and I'm not going out of business. All we've done is grown from 3 to 70. And we've done that through the implementation of working with people, giving them a budget. The hardest thing for companies to do is budget. So if I'm going to charge you X dollars a month for the year, you know what your budget's going to be. So if you come to me, I will set up a budget with you. Or the first time I speak to people, I always want to understand what they're doing. I'm not interested in getting my first dollar because the way we've built the firm is we've helped companies grow and we've grown along with them. So a younger company that's coming in to meet with me, I'm not going to hit them up for the money right off the bat. I'm going to work with them, help them grow, come up with a plan, and work within their plan to help them become a successful company. And when they become successful, I make the money and become successful with them.
That sounds like a great model.
It's the unity of interest. I mean, the irony is the traditional legal model, you're adverse to your lawyer because the more inefficient your lawyer is, the more it costs you. So we've effectively turned that model on its head. So if I have 2 partners on a phone call with the client, it's not because I'm billing for 2 people. You're paying me the same thing anyway. It's so I can make sure you get the best representation.
That's a great model.
Why
doesn't everybody do that?
Because sometimes it's not as lucrative as if I build you hourly.
But you're number one.
We're number one, but that's in terms of getting the deals done. No, it's caught on. I mean, we were one of the first in the city to actually come up with that model. And as what do they say? Flattery, the copying is a compliment.
Yeah,
Flattery.
imitation is the sincerest form of flattery.
Right.
Yeah.
So then they all took the model.
So somebody says, I've done a friends and family round. Is there a point where they can't keep going to friends and family?
Yeah, when the friends and family say we're done.
Okay.
But at some point in time you need to figure out what's your vision. Okay. You need to, what I said earlier, you need to get the narrative. You need to have the storytelling. At some point, you're going to need to speak to the lawyer, and the lawyer is going to introduce you to make sure you have the financial people that will get you in order, to make sure your finances are in order. Before you go public, you should have your own contract. A lot of people forget when they're going public, they forget to have an employment agreement. I mean, you wouldn't believe how common that is. I started
an employment agreement of
the CEO. The CEO forgets to get his employment agreement signed.
That's a good point.
I mean, everybody says, but it's my company. No, it's not anymore. Once you go public, it's not your company anymore. So those are things, you need to talk about, your narrative. Typically, you need to build a deck. You need to put together a presentation that, in terms of raising capital, that tells the story of the company and, present it to the banks and present it to funds. I mean, one of the ways that we've been very successful is we have relationships with the banks, we have a relationship with the funds, and we can bring these issuers, these companies to these entities and explain to them how we believe in this company. We believe in this model. We believe in this business. This is, earth-shattering technology. The CEO, it will, super impressive. And we think you should look at this. And that's, to be honest with you, that's how we've become number one. We get the companies and we bring them to the banks, and the banks say, wow, that was great. Let us bring you these clients too. And that's how we've grown it. That's the secret.
So it's more than legal advice.
Yes, because everybody
sounds like you're doing a lot of advisory and consulting on multiple levels for each of these companies, where you're educating, you're teaching, you're introducing, you're connecting,
right,
you're networking them.
Right. And
those are big assets.
Those are all assets. And one of the things when we are the most active out there, we have relationships with all the investment banks, and we have the knowledge. And I always tell people when I first put you on the monthly fee, make me lose money. Ask me a lot of questions, because when you're charging hourly, people are always reluctant to call a lawyer. What was Shakespeare's quote? You think talk is cheap, call a lawyer. In my model, you're paying me whether you're calling me or not. You might as well call me. And this way you get more educated and the process makes more sense to you and you become more successful. And when you become more successful, I become more successful.
That point you just said of how you tell a client, we're on a flat retainer, so call me. You might as well get your money's worth. I also think there's a flip side of that, because it's just like when you're training people and you're trying to take them through a process. I used to say, ask the questions, because if you don't, we're going to have a problem at some point. And that problem could be way more expensive than the time it takes to answer the question now.
Absolutely, 1,000%.
Yeah.
So the answers are, I always tell people, if you ask the question, you'll save yourself a lot of money later on. And the old way, when you're charging the hour and they call up and they ask you a question and they get a bill for $8,972, they kick themselves for asking the question. But if they didn't ask the question, they would have gotten a bill for $500,000.
Okay, so somebody's gone through their friends and family and they call up Marc and you say, listen, we need to get your financials in order. And so you're maybe introducing them to some, accountants that can do that are familiar with the publicly traded requirements. And then did they need a board before they go public that you help get involved with? Or They do need a board. So do you help with that?
Sure. We help with everything. Certainly you're going to need a board. Certainly, if you look at some of the reasons for being public, and
let's look at those reasons.
Yeah, it's interesting. I read an article on the Wall Street Journal last week, talked about how Europe should be nervous because of America's hegemony with regard to the capital markets. So apparently in the UK last year, at the beginning of this year, there were 6 companies that went public for like $280 million was the IPO revenue. In America, it was about $40 billion. And, there are so many companies in Europe that are coming over to the U.S. Last year, 60% of the companies that listed here in the States, 58% of them to be precise, were foreign issuers. So there's a recognition around the world that, American markets are still dominant. And they're going to be. And, you have all of these companies. You have Klarna, the fintech Swedish company, listing here. You have Arm, the English, the UK chip company, listing here. There's an incentive to list here. The capital is here in the States. We are working with a lot of foreign countries, foreign issuers that, either in Malaysia and in China and all over the world, and they're choosing to list here. And we're helping them. I mean, another reason to list here, frankly, is FanDuel, the CEO of Flutter, the public company, the parent company. When they moved there, they did a year in London. They moved here. His compensation went up 300% because here there is traction, and here he gets his return on his investment. Now, the other interesting thing, which I learned, is it's not that there's more money here. There's actually a lot of money in Europe. It's the mentality here. So 70% of the savings in Europe is put in like savings accounts, okay? In America, we all hear about these 401ks that all these companies have. So like CalPERS, which is the California insurance, they have all of their 401k is invested in public companies. So the 70% we deploy and invest in public companies. The 70% that Europe has sits in the high interest earning savings account. So it kind of fuels the American dream, if you will.
Yes. And if you look at that charts, all the charts, they say if you invested, $1,000 when you were when that baby was born, and just this S&P 500, if that's the only thing you invested in, it's like $1 million by age 60 or some, depending on the years, some of them show, or who's doing the charts, some say it's even sooner.
Right.
Yeah, that's
the recognition. For example, since the capital is being deployed, another thing I thought was interesting, since a lot of people aren't able to get venture capital in Europe, so they come to the U.S., to Silicon Valley or here in New York to look for venture capital. So once they get the venture capital here in New York, or in America, there's a push to have them list here in America because these companies, these venture capitalists, these early investors understand the American markets and would prefer to have it invested in the American markets. And then they bring some of the production so they can oversee the production. So they bring some of the production here in America, or some of the technology is done here in America. So these investors can oversee it as well. So there's lots of reasons that you're seeing, the increase of the U.S. marketplace relative to Europe.
You mentioned the venture capital markets. When you have companies come to you, when do you think, do you sometimes have to say, listen, you're a venture deal still. You need that kind of money versus an IPO.
Yeah, absolutely. And the question is, how much, the question is how substantial is your company? Okay, so, the more revenues, the more substantial your company is, the more options you have. I mean, I was on the phone with a company yesterday, and there are two companies. One of them had substantial revenues and was speaking to investment banks and got very favorable terms. Another one doesn't have any revenues, was speaking to an investment bank and got some pretty egregious terms. And those will usually dictate, how substantial is your company. So if it's an early stage company, you're going to need the venture capital funds, the private equities. You're going to give up a lot. In a minute when we talk about the difference between the different means to go public, the question is, how much are you giving up to do that? So if you're listing as an IPO, you're giving up some. If you're going for early capital money, you're giving up a substantial percentage of your company.
Let's talk about those ways to go public. You said IPO, we've got initial public offering, but there are other ways too.
Yep.
And how are they differentiated, and when are they appropriate for one company versus another?
That's another great question. Everyone knows what an IPO is.
I'm doing good on the questions this morning.
You must really
I like talking to smart people who know what they're talking about. So
you must do this. But no, I mean there's another way in which it's a direct listing or a DPO, direct public offering, where the company can take itself public. Now the advantage of that is you're saving money because you're not hiring an investment bank, but you're taking yourself public. You're filing the necessary documents with the SEC, and you'll be deemed a public company. You're not raising money in connection with that, because typically what you're doing is you're registering existing shareholders, their shares. So if I have, using your investment money, your early capital money, so if I have a shareholder that put in 10% of my company or put in money into it, they want to get access to their money so they can get liquidated, they can have an exit strategy, I would register those shares with the SEC and use that means to get the company public. So I wouldn't be paying the bank, the investment bank, 8% to do an IPO. I would just be filing the registration statement with the SEC and getting the shares registered that way. So I'd have more control. I'd have less dilution. So if you're a substantial, Spotify did that, but again, there's not a lot of Spotifys out there, but certainly they can do that where they have the means, they don't need the capital. So while a lot of these other companies, smaller companies, and we help the smaller companies, need capital, question is, do they have funds that are willing to back them? So sometimes what we've done is we've done a fundraise at the time they go public themselves.
Okay, so somebody goes public themselves. They do this direct public offering.
Correct.
Now, where are those shares trading?
Great question. Another great question. Ding, ding, ding. So they, in a perfect world, they'd be listed on an exchange because they'd be listed on Nasdaq or the New York Stock Exchange. They've certain requirements to be eligible for that, but let's assume they meet those thresholds, because that's when you have the advantage of being public, because that's why so many of these companies in Europe are coming to the States, because there's a liquidity. You have stocks trading on a regular basis. You have the ability to access the capital markets. So if it's on a listed exchange, like a Nasdaq or New York Stock Exchange, that's where you would like to list.
Now, at At what point, if you were working with an investment bank versus deciding to do this yourself, and you're not Spotify, so you have a little less attention.
Right.
Hello, Spotify. I love you. You host my podcast. But you're not Spotify. So if you do an IPO and you're working with a bank, there's all different size banks, as we know. There's smaller ones to the behemoths. Right. And then versus that direct public offering where you're doing it yourself, what would be, do you as the law firm get involved with bringing them to a variety of exchanges as possibilities, introducing them maybe to the bulletin board versus the Nasdaq versus, the New York or maybe even a foreign one?
Sure.
To try to get things going for them?
Sure. So first of all, we would introduce them to the banks, okay? Because we work with all the banks, and that's how we're active in it. So we would bring them to the banks. We would take the temperature. Some banks prefer, technology. Some banks prefer IPOs. Some banks prefer add-on subsequent offerings. So we figure out which is the appetite that the bank might like. Some banks actually like private deals and have them teed up for being public in the future. So we have a bunch of those going on as well. And then in terms of the exchange, it's really going to be a question of what are you eligible for? If you don't meet the requirements for Nasdaq or the New York Stock Exchange, you may want to list on the OTC markets. Again, people prefer, if they can, to go up to the listed exchanges. If they can't, they'll start otherwise. But certainly, what we try to do at Sichenzia, Ross, Ference, Carmel is we try to put together the entire mosaic for you, introduce you to, at some point you'll need the investment bankers, at some point you'll need the investor relations, at some point you'll need the accounting team, at some point you'll need, et cetera, et cetera. And what we try to do is we bring it all together for you and help you through this process. So the goal for us is to allow you to focus on your business and allow us to help you become the public company that is going to achieve your success.
Another thing you hear a lot over the years is reverse mergers. What can you tell us about a reverse merger for somebody who says, well, I want to go public, but I heard there's this company that could kind of like buy me, but I don't really know what that means. But, they have shares and they're publicly traded and I want to be publicly traded. So that's a quagmire in a lot of ways without good advice. Right.
So the first thing is, yes, a reverse merger is effectively where you have a public company that acquires a private company. If the public company is a shell, has no real business operations, it's a little bit more problematic because there are rules that prevent you from uplisting immediately and make you seasoned. But if you have a public company that has operations and acquires you, then you can step into that company. You can continue to run the company. So it's called a reverse merger because the acquisition company that is being acquired takes over the public company and runs the public company. So the public company acquires the private company, and the private company ultimately runs the public company. So that's a quicker way to do it. It's a cheaper way to do it. And, the advantages of that is exactly it. A public offering will take you 6 to 12 months. A reverse merger we can get done for you in a month. But there are a lot of, again, we would need to vet the company for you to make sure that there's no landmines hidden or otherwise.
Been there.
Exactly. We've all read those terrible stories. And again, that's why I think it's very important for people to, confront and these issues and contact an attorney. I mean, at Sichenzia, Ross, Ference, Carmel, that's what we do. We help you understand the risks. We help you navigate the process, and we help you become that successful public company we know you want to become.
And I cannot testify enough to the fact of how important that is, and to get that advice early on. I mean, there's a reason I have white hair. and one, we'll leave it nameless, but, a company that really high-profile company that merged into a shady got acquired by a shady company, and then all of a sudden tons of shares are coming to the market that were never registered, and what's going on? There's no possible way this number of shares is trading for this company because there weren't even that many authorized in issues, supposedly.
Right.
So, it's really, I can never encourage people to get some good legal advice right away before you talk to anybody.
And the problem is you can't undo those.
No, you can't.
Like you can't, like
It's
once
just a nightmare. Your company's gone, or you're in no man's land, which is even worse.
Right. So we call it SEC purgatory.
Yeah.
Where you're not in hell yet, but you can't get out of it.
Yeah.
And the problem then is, the expression is the tube is out of the toothpaste. Like you've already done the merger. So when all these shares are coming back, where'd they come from? Or I didn't know you had this contingent liability out there. Why didn't you tell me that? Well, you're supposed to do some due diligence, and that's what we do for you, the due diligence, to see if it's there.
Mm-hmm. Now, this is on the low end of the scale of an IPO or something, but you have people see things like Kickstarter, where they're trying to do these Reg A, they're trying to do these crowdfundings. Can you talk about crowdfundings a bit for this audience?
Sure. Crowdfunding is, most of it's through an online platform, and they go around to a lot of smaller investors and raise money. Again, it's you can control the narrative, you can control the costs, although there's a marketing cost, a substantial marketing cost associated with that, where you have to tell the story and you have to pay an advertising campaign. But you can control it. You don't if you set the price. I mean, some of the people say that the IPO, the investment banks set the price. I don't want them to set the price. So with a direct public offering, the market will set your price because you won't have someone artificially setting it like the investment bank. With a crowdfunding, you could set your own price. I'm selling it at $1. And if you want to buy it from me at $1. And a lot of companies are starting off that way. And then once they raise enough money and then they get audited financials, and then they can go list themselves. And, we've had some good success with taking those companies early on and listing them onto Nasdaq, done a couple onto Nasdaq. And again, it's a way to start. And you can start without even having audited financials. I mean, you can start very early.
And at what point, if somebody says, "Oh, I'm just going to do this," should they get in touch with an attorney before they start to list on something like that, or should they just do the cowboy buckaroo kind of thing?
No, you should figure out what you're doing. I mean, I think that once you're a public company, on the one hand, you have responsibility to your shareholders. But I also think it's a good idea to do the right thing for yourself. I mean, don't forget about your shareholders. Sorry about that. You absolutely should have your shareholders in mind. But, you should figure out what's your vision, what's your goal. Don't just start on crowdfunding and try to raise the money. What do you want to do next? That's why you should start thinking about these things. And that's why, at Sichenzia, Ross, Ference, Carmel, we try to help you figure out what is your next move. So if you raise $1 million, what are you going to do with that $1 million? Do you want to be public? You're just looking to raise the capital so you can develop this next theory, develop the next product. Do you want to just use that money, reinvest it to tell the narrative, to get the branding and marketing out there?
What are the biggest things you would advise someone to beware of? Where are the landmines in the process?
I mean, the problem is there's landmines everywhere you step. Certainly, you hear a lot of bad stories, kind of like your white hair story. You got the white hair where companies, I didn't know this. Well, you better know it before you make that decision. Make sure you have the plan, your goals, the structure, your strong leadership, the storytelling. When you put together a deck, when you're trying to raise money and you're putting together a deck, you're going to start telling your story that way. You're going to tell it to investors. I sat in last week at an investor presentation. We have an IPO that a bank is doing, and I'm listening to this company tell their story. You need to tell it in a way that makes sense. You need to tell it cogently. What was that? Margaret Mead says you never get a second chance to make a good first impression. So there's the problem is landmines all along the way. And even once you're public, the landmines don't stop. In fact, they probably come more because if you have a wrong step there, it's very dangerous.
Now somebody's public. The company has made it. You've helped them get that IPO going or that direct placement and direct public offering, and now they're public. What do they have to? What are the requirements at this point?
Right. The requirements are to have regular filings. First of all, if you're a foreign issuer versus a U.S. issuer. So a foreign issuer has less filing requirements, and it's consequently a little bit more nimble. So if you're listed in the UK or Europe and you want to list here in the States, you have the home country rules govern your filings. And as you said earlier, you do one annual filing, you do a 20F, you do a 6K, you do different filings than you would do here in the States. But those really, you just need to be mindful of everything as you're going along. I mean, it's really there's no simple one size fits all. I mean, everybody thinks I can just figure it all out and it's simple. It's really not. And there's different things to be mindful of through the entire process.
So you've got quarterly filings, the 10
Qs is the quarterly, the 10K is the annual. You have an 8K. Which
let's go into what an 8K is and when companies should file an 8K, because I know a lot of companies debate this and they think they don't have to. Right. So I'd like to hear the official legal opinion.
I mean, there's a whole section on what qualifies for the 8K, but effectively, if it's a material event, you need to file an 8K disclosing it. And, if you have a press release, you can issue a press release. A lot of times a press release is going to have, if it has new information, we encourage you to put it on an 8K and file it in connection with that 8K as well. So it's put out widely disseminated is the nomenclature.
You used the word material information. And material information is a very important thing in the securities world because that's where insider trading issues happen. Can you define material information?
That's always the question, right? What they have reasonable person standard. In the tort analogy, it's what's a reasonable person. What's
That's
material?
Very subjective these days.
So what's material is something that is important for you to when you would make a decision to invest in the company. Is kind of a general rule of thumb. So if it's something that I would want to know, it's something that I should be telling people. That's a kind of rule of thumb. One other popular way of going public these days is we forgot about SPACs.
Oh, let's talk about those. Yes.
So SPACs are the old-fashioned blind pool where you have a public company that has $50 to $100 million cash in it, and that company is looking for operating companies to acquire and run.
Wait a second. Can we go back to the phrase?
Sure.
What is a blind pool?
A blind pool is a public company that has cash in it. Okay, so let's say you have a SPAC that has gone public and has raised money from its investors and sitting with $100 million cash in it today.
Does it have operations in it?
It's got nothing.
It's got nothing in it.
Right.
It is a publicly traded entity that has cash sitting in it.
Correct. And it has a management team. And the management team has expertise in technology. So the management team looking for companies to acquire to vend into the company, the SPAC. And that's called a de-SPAC because what happens then is...
Did you say D?
D.
D. The letter D.
When you unspac, D-E. When you unspac...
de-SPAC. Yes, got it.
De-escalate.
Yep.
Kind of like this conversation, we de-escalate. So when you stop being a SPAC and you acquire a company, that's when you do the de-SPAC process. And then there's an option for people, with investors, if they want to continue to stay in this or they want their money out. But the relevance is it's a quicker way to become a public company. So once you merge into a SPAC, you are public and you don't have to go through the process by which, the IPO process. It's a quicker process. And technically you then have a company that has the expertise to run the business line. And it's very popular. It was very popular the last couple of years. Banks and, lawyers, and we did a lot of them. And, it's very lucrative and it's very popular. And then you have X number of time, whether it's 18 months, whatever it is, to find a company to acquire as a SPAC. You can get an extension, but you have a shelf life on finding a company to acquire.
And do those people who blindly put their money into this special acquisition corp or the SPAC, do those people get a say in what that investment is?
Well, they get better than a say. They get the right to take their money out. They don't like
they
it.
do. Okay, so
It's even better than a say. But so if people take their money out, and a lot of times people are taking their money out, what you then would have to do is you'd have to do a PIPE. You'd have to do a PIPE being a private investment in a public equity. And remember, the SPAC is public. You would do a PIPE at the time that you close the de-SPAC. So when you acquire the operating company into the SPAC, you would then do a PIPE to raise capital in connection with that.
So there's the potential for at least 3 legal transactions all at once to get that company public.
Sure.
Wow.
And again, it's going to be faster than an IPO. We had a call last week, with an investment bank, and they, instead of this particular investment bank, was saying this was a data company, a very successful data company, and saying instead of doing an IPO, maybe we'll do either a SPAC, which they were looking for, or just straight merger into a Nasdaq listed company.
Are there a lot of SPACs out there right now? There are. So there are a lot of these companies sitting with potentially a lot of cash that are looking to acquire companies. Do you find you're working with SPACs that want to add more than one company in to the mix?
Well, that kind of goes to the narrative. What's your messaging? We have another company that I'm working with. They have several businesses, and the question they're trying to figure out now is, does that help them having several businesses, or does that kind of make the message a little confusing? If you have too many businesses, should you just be in the business of doing, this particular line, and if you also do this line and you do that line, is that helping your business model? Is that confusing your narrative? Is that taking away from your people who have to spend time on the different disparate businesses? Remember, one other potential disadvantage of being public is it requires more time for management and more costs. So, if you and I are running a company, we can spend our time just figuring out what's the best way to implement the plans. If we're running a public company, we have a lot of other things to take into consideration. We have to have a vibrant financial section of it. We have to have, more things that we would, we have to have someone spending time thinking about what's material. We have to communicate with the lawyers. We have to do the 10Qs, do the 10Ks. We have to do the 8Ks. We have to, so again, it takes more time, more effort, but it generally pays off nicely.
Very interesting. So you've got companies at an extreme of, let's say, an LVMH, that has zillion companies. I'm not even sure how many brands within it. But do you come across companies that say, okay, here's this SPAC, it's got X amount of dollars in it, and I'm going to acquire, I'll just use makeup. I'm going to acquire this mascara company and this foundation company just because I'm trying to, it could have been food, this hot dog company, this French fry company, this hamburger company, but we're going to put it all in and we're going to create this new food conglomerate kind of thing, or this new makeup conglomerate, or maybe it's automotive parts or something. Are you seeing much of that these days, or is it one company and let's see if we can get this off the ground?
No, people like the multiple companies because it gives you, it gives you heft. It gives you, more revenue. It gives you a better story. The point I was trying to make, which I think is less advantageous, is this makeup line and this hot dog line.
Right.
That's the part that's confusing.
Yeah.
But the narrative of becoming a makeup company and having lipstick and having nail polish and having whatever else you would have, that is a compelling story. Even drug companies. Drug companies, if a company can, we call them multiple shots on goal.
Right.
If instead of doing one drug.
Yeah, no company wants to be the one-trick pony.
Correct. And so it's always better to have more. But again, it's should be a drug company, not a shoe company, drug company, makeup company.
Right. Okay. So it's a special SPAC with a theme.
Right. And that's typically what it's done.
Yeah.
It typically has a technology theme. But that's not just true of SPACs. That's true
companies
of
in general.
Absolutely. I mean, if you have a company, so if you want to go public and you have, and you have different businesses, that's fine. We have biotech companies that acquire multiple assets. So it's not a one-trick pony or not one shot on goal because, a lot of times it's not going to pass. And, if you have 3 drugs that you're developing and one of them doesn't pass, you still have 2 others that are going strong. If you only have 1 drug and it doesn't pass, you're not doing as well as you otherwise should be doing.
As you said, 20 years owning an investor relations company, one of the trickiest things was when a company would say, yeah, well, we're this oncology company. And, oh, yeah, there's this thing we're going to, buy for diabetes. I'm like, this is going to, you're having a hard enough time raising money in oncology over here. How about we stick with this a little while and prove we can get something across the finish line or move it along before we start thinking diabetes? Because that just confuses investors. They just tend not to like those. I mean, if you're a mega pharma company, but when you're a biotech, people want to know you can kind of stay in your own lane, maybe have multiple shots on goal within that lane.
Right. But it might not be terrible to have that asset on the shelf. Where you can, also have the right to develop that and raise capital for that, or a couple of them on the shelf.
Yeah.
That's another good model.
Yes.
It's probably going to be difficult for you to raise, or might be difficult for you to raise for all the different drugs you have. But if you have, 3 others on the shelf and you're focusing on this one right now, you have access, and the market knows that you can avail yourself of the other assets.
Do you think investors, in your experience, have a preference for a particularly kind of publicly traded company when they're coming in those initial stages, whether it's a SPAC or an IPO or, a direct public offering or a reverse merger, or is it just plain, it's a good deal, let's get good terms and let's fund this?
I mean, I think everyone wants the disruptive technology. I mean, everyone uses that term, but, it's so disruptive. How many things really disrupt? But the answer is, if you have something that's innovative and you have something that has excellence to it, I think it's very compelling. I think that's something a lot of people are looking for. But again, don't write off brick and mortar. If you have a steady company that really makes steady revenues and has steady returns, there's something attractive about that too. Not everyone wants a moonshot.
Right.
Everyone wants something that they can see. Many people want something they can see progressing along.
I always hate when the time is up, but the time is up.
Oh.
But that said, I want to hear some parting words from you along the lines of, what would be your most pertinent advice to someone who's thinking of entering the world of the capital markets?
Call me.
I love it.
No.
Can't do better than that.
No, but I'm saying, I mean, there are so many landmines, and a lot of these landmines are unchangeable. So once you step on it, you've lost your leg, heaven forbid. So I think you really need to make sure you are doing things right from the inception. Whether you're acquiring an asset, whether you're raising capital in connection with that. I mean, there are terms in the agreement that you may not have realized that you just gave your company to the investor. There are just so many things that you need to be mindful of that I would really encourage you to see a lawyer or professional to make sure you do it right early on.
That makes a lot of sense, because I've certainly seen the damage. I always say, why is it that I always seem to be called after the crisis has occurred? I'd like to get called a few days before.
Right. Well, if they didn't have the crisis, they wouldn't be calling you, right? But I mean, and that's what you need to do. You need to recognize that it's a very nuanced area.
Yeah.
And, if I do my job well, you're focusing on your business and I'm focusing on your legal formation and your development.
Well, Marc, thank you so much for being my guest
It was
today.
my absolute pleasure. I appreciated the time, and I really enjoyed our conversation.
So did I, as always. I always learned something from you that gets me thinking a little differently.
That's awesome. Thank you.
Thank you. My guest today has been Marc Ross. He's a founding partner at Sichenzia, Ross, Ference, and Carmel. And they have been for years. They work in all areas of the securities business on multiple sides, but they for years have been the top issuer counsel on a variety of lists. So no matter where you look, you're going to find them right at the top of that list. I learned a lot today. If you know someone who wants to take their company public or is just thinking about testing the waters or wondering what that actually means, you might want to follow their news feed, follow them on social media, follow and pay attention to what they're doing so you can start to learn the landscape. And if you're getting closer and closer, hey, I'd give Marc a call because he knows his stuff, as you saw today. Please share this episode. I'm Diane Grissel. Thank you so much, Marc, for joining me. This has been a real pleasure.
Thank you so much. My pleasure.
Thank you. And thank you, everybody. Please hit subscribe. There will be information of how you can learn more about SRFF. And hit subscribe, share this, and I look forward to seeing you again soon. Take care.